Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. The dust is settling somewhat as markets get a handle on a global sell-off this past weekend that saw investors move money out of markets due to worries of a recession in the U.S., a slump in earnings from giant tech companies, and Japan's Nikkei seeing its worst drop in almost 2 decades. To unpack this global market situation is Fidelity's Director of ETFs, Andrei Bruno. Andrei sits down with host Pamela Ritchie to discuss how the market could recover and what this all means for investors. Andrei says although the global sell-off is a bit worrisome, generally market corrections are healthy. He says now is not the time to panic or make any extreme moves. He says now is the perfect time to diversify your portfolio and take advantage of active management where investment professionals can make sense of the chaos. With a wealth of experience in bonds and capital markets, Andrei says to keep a close eye on fixed income. Perhaps it may be time to add duration to your investment sleeve, specifically in U.S. bonds. Andrei adds many questions still linger as global markets begin to calm down. He adds this probably won't be the last you'll see of market volatility, but a U.S. recession won't come tomorrow. Stay the course and focus on diversification. Today's podcast was recorded on August 6, 2024.
Great to see you, Andrei, on a day like today. We're lucky to have you.
Great to see you as well. A bit of exciting end to the long weekend there for us in Ontario.
That's right. That's right. There were reasons to make sure you tuned back in yesterday, at least the American markets and global markets. Your background is bonds and also capital markets is an expertise of you. You're now head of ETFs. But let's dig into what we saw over the course of the last couple of days. The big question is, do we need to keep worrying?
Yeah, so that's $1 million question I think everyone's asking right now. Obviously, markets have rebounded a little bit this morning, which I think is a bit of a sigh of relief for, I think, everyone, all market participants and investors alike. So there are a few things at play. Obviously, we're in earnings season right now. So, there's been a lot of eyes on tech earnings, of course. Tech stocks started responding even late last week. We started to see a little bit of sell-off in the tech names as earnings came in. And the big story there was AI. Obviously, tech has had a tremendous run this year, most, carrying kind of the S&P 500, so to speak. Obviously, the Mag 7 is highly concentrated in tech names. But I think the question that a lot of analysts were asking is just taking a look and listening to earnings calls and seeing, there's a lot of plans on AI spending moving forward. So I think the big question is this AI spending going to be justified in future earnings and future revenue growth? So I think that's what the market was questioning. So we haven't seen a ton of it materialize just yet. Obviously, we're seeing headline news about, Google AI and Meta AI. And all these products coming to market. But again, we haven't seen that translate into much of the earnings growth or much of the revenue growth. So that's the big question is, long term, I think everyone can expect, AI is going to change the market, change the economy. But the question is in the short and medium term is that going to distill down to dollars and cents revenue, top line growth and bottom line growth for these companies?
And are the valuations where they need to be? It seems that's what the market is trying to work it out. So we had that come. We then had the economic backdrop as well. We had data coming out. We know the Fed. Let's begin with the Fed's comments last week that we obviously know they didn't decide to cut. I don't know, some quick thoughts on that. Then we'll get into the economic data points that came out. But, they didn't cut.
They didn't cut. They are standing pat right now. We still have several more meetings this year. Market is pricing in, I believe, around 4 cuts from the Fed by year end.
That's a lot.
That is a lot. I believe that's probably a cut per meeting for the remaining meetings.
And maybe big ones. I mean, this is part of the discussion. Is it 50 basis points? You even hear, 75 basis points thrown around. But the point is, it could be bigger than 25 basis points.
There were some folks calling for an emergency cut from the Fed in between meetings, which I don't think we're going to see. As we know, inflation is still above their 2% target. I think some of the data points coming out that are giving people some pause or some of the employment data has been softening. The unemployment rate ticked up 0.2 there recently, which was a bit unexpected. So I think that's kind of filtering into this conversation now is, do we need to move? Do we need to move faster? Do we need to move now? So again, the market is starting to price in more cuts there. Some of the other fundamental data is a little bit hit or miss. Obviously, consumption is still hanging in there in the United States, surprisingly, given that COVID savings have been drawn down. What's flashing a little bit of signs of worry are obviously delinquencies among more auto loans and credit card delinquencies are ticking higher. Still not at crazy high levels, but they are ticking higher, and something to take note of. Obviously, that those sort of metrics do filter down an overall consumption story and gives us a glimpse of what could be moving forward. So again, I think for the Fed, like we said, the inflation's still above 2% target, but the Fed does have a dual mandate, which varies a little bit from the BOC. The BOC has a strict inflation mandate, get into your 1 to 3% band. Whereas for the Fed, they've got that 2% target, and to maximize employment as well. So that slowing down in the employment story does potentially give them a little bit of impetus to maybe move quicker than we would have thought maybe a couple months ago, and perhaps with a higher magnitude than we thought a couple months ago.
It's really fascinating. So when you look at back to your bond history, we're looking at spreads. We're seeing a widening story for a long time, and there's a lot of news over the course of July. Didn't move. They're moving. What's that signal for you? I mean, let's go back in.
Yeah, I feel like for the last 2 years we haven't really talked about credit very much because it's been fairly tight, hasn't moved a ton. So we are starting to see things widen out a little bit, whether you're looking at high yield or investment grade. So again, we're not seeing spreads blow out. We're not seeing tons of defaults or anything of that nature. Certainly that stuff has ticked up a little bit and started ticking up when interest rates started moving higher. But again, still at relatively low levels. But anytime I see credit spreads move, I always pay close attention. The bond markets, we used to joke back when I worked on the rates and FX side with the equity folks, as we always just said the bond markets are smarter than the equity markets.
I feel like that's just sort of a truism. I mean, I don't know if it is true, but everyone says that.
Yeah, fair enough. I mean, some of the equity analysts might disagree, but nonetheless. So when the credit markets start moving, we like to pay attention. Why are things moving? And again, it potentially gives us a glimpse into kind of what could be down the line. So again, at the end of the day, bonds just come down to a dollar and cents and cash flow game, right? Can these companies pay back their loans ultimately? So when we see spreads widening out, we start to pay attention. So again, nothing screaming, there's not red lights flashing just yet, but it's interesting to take a look at that. And obviously you need to take it in the context of great other data points as well. So obviously when you overlay the employment story, it starts to paint a bit of a picture. So again, not saying we're going to be in a recession tomorrow, but certainly something to keep a close eye on.
Yeah, fascinating. We've got a bunch of questions coming in. There's more things to ask you. So any concerns about the reverse carry trade affecting global markets for the remainder of the year? Let's dig into what the Japanese yen, its levels, and a surprise hike from the BOJ means to this whole sell-off.
Yeah, so the BOJ hiked rates. To be perfectly honest, I can't tell you the last time they did hike rates.
They never hike rates.
I don't know if they've hiked rates. It's been quite some time. But it's been one of those things where the BOJ, you just expected rates to stay low forever, basically. And the carry trade, just as a quick refresher, is essentially you borrow in a low-yielding currency and you invest assets in a higher-yielding currency. And as long as that exchange rate stays, around the same,
it works well.
You typically make money. So what we've seen over the last month of July is we've seen the yen appreciate the US dollar depreciate about 10% against the yen. So again, that essentially breaks your carry trade. So what we've seen, and this has certainly contributed to the sell-off yesterday, is the unwind of that carry trade. And often these carry trades are levered as well, so it can cause quite sharp movements in the overall markets. The other thing to consider, I've seen some reports out there, and it's probably impossible to get the exact number, but some of the reports are showing that this isn't over yet. There's still quite a bit of the carry trade to unwind. So it's possible that could continue to place some pressures on markets moving forward as well.
Can you give a little bit of context to just how wide a swath of investors are using that carry trade, so borrowing at something lower to then invest in assets in another currency? Is that every asset manager, or is that just a few? How big is that?
Certainly, it's a quite popular strategy in the hedge fund space as well. That's why I mentioned the leverage as well, because often, as we know, hedge funds do employ leverage. It's been such a popular trade because it's worked. the BOJ has kept their rates where they are. The BOJ has also historically wanted to maintain the FX rate at reasonable ranges, so they've stepped in if it's getting overvalued or undervalued to try to maintain.
They control it, yeah.
So again, you had these two levers always kind of making that trade work, and in one fell swoop, both those things kind of fell apart. They raised rates, and the exchange rate moved drastically as well.
We talk a lot about forward guidance. We talk about a lot of the central banks that are in this particular continent. But the BOJ, what they did, was it a total surprise, or did you see any commentary leading up to it?
There were some indications that they were going to hike rates, but I think perhaps what wasn't factored in was how aggressive perhaps the currency was going to move. Because again, 10% in a month, USD devaluation relative to the yen is a big move. FX markets are typically the vault between 10 and 15, so they are higher than bond markets, a little bit lower than equity markets, but that is a major move for a currency. So I think perhaps folks weren't expecting that large of a move in the currency, and that's what potentially caught people off guard.
Yeah, and that's what makes people sell really fast. I want to get to sort of ultimately what you might want to do to invest what's going on in the ETF space, but just a couple more on sort of what's leading into this market right now. So can we still discuss a soft landing? Could we call this a healthy correction? Is there still room to put that into context for us?
Yeah, I think the market's done fairly well this year. Specifically, those tech names have done tremendously well. So it's healthy every once in a while to have a bit of a pullback and do a reassessment of current levels, valuations. So again, there's nothing too concerning. Obviously, we don't like coming in, taking a look at our statements and seeing a red line item, of course. But I think it's generally, market corrections are healthy. But looking forward, and the big question is, we've seen kind of this pullback in tech. Is it time to buy the dip? Is it time to get defensive? And I think that's the question everyone's asking themselves right now. I think what we can expect moving forward, given the macroeconomic backdrop, as well as these dynamics with the carry trade and so on, is, if you take a look at the VIX, we certainly got a spike in the VIX. Went north of 35, it's back down to, south of 35, but still north of 30 right now when I checked this morning. So, in a scenario where we're going to see increased volatility, increased uncertainty, I've said this, and this is textbook, obviously, but diversification is obviously your friend. And
maybe a low vol sort of approach to things, if this is what you want to combat.
That's right. Momentum has kind of been the leading factor this year. If you take a look at 12-month returns, momentum has been the play in terms of factors. If you do want to play a little bit more defensive, obviously, low vol is an area you can explore. But again, if you're a little bit more uncertain about the market moving forward, obviously starting to take a look at playing a little bit of defense, maybe taking a look at your fixed income portion. Duration has been playing its part right now. Back in 2022 when everything was kind of correlated and bonds were down, equities were down. Right now the correlation is getting back to what we've traditionally seen. So as equities are going down, bonds are going up. So again, duration can be your friend in this scenario, and it is time to take a look at your fixed income sleeve. Okay.
Really interesting. And would you say that this is a moment for ETF flows to start changing? I wanted to sort of ask you, when we knew that you were coming on, ETF flows was going to be a discussion. Let's bring it up to like today and a moment such as this. What do you expect to see in terms of flows? And then we'll get a bit of a history too.
So this year has been a strong year for ETF flows across Canada. When you take a look at the numbers under the hood, it's been an equity-dominated market this year. There has been quite a lot of fixed income flows as well. When you take a look at the equity flows, it has been primarily in U.S. equities. I think what'll be interesting moving forward to see if maybe we see those trade kind of in parity, see flows in parity, see if we see an uptick in fixed income now, given there's a little bit more uncertainty. Because a concern as well is, if we rewind to the first half of the year too, is, soft landing or no landing. We're just going to keep going in the U.S. So there was certainly some uncertainty. Is like, if we don't even get a recession, rates could continue to trend higher. Whereas in Canada, it's a bit of a different story. Canadian bonds have been performing decently well because rates have been continually moving lower along the Canada curve. So I think now there's the question for U.S. bonds is, is this the time to start adding some duration now?
Right.
If we are going to get some more uncertainty, maybe we are going to get a soft landing, or maybe we're going to get a hard landing. Maybe it's time to take a look at fixed income a little bit more, specifically around U.S. bonds. So certainly we've seen rates move a little bit lower in the belly of the curve in the U.S., specifically over the last few days, few weeks, as now the conversation is the Fed going to cut. So we've seen the belly come down, we've seen the curve steepen a little bit. So again, I think U.S. fixed income is going to be an interesting area to take a look at. Again, for the diversification, I think bonds are going to help if we do get a rocky road in front of us.
Okay, and do you see sort of a rotation of perhaps within sort of the money markets / fixed income space of moving from money markets, which are absolutely at the front, into the duration? So within that space, do you expect to see that?
Yeah, so we certainly, on the Canadian side, we've certainly seen some interest in not so much the money market. So when you think of the money market, or you think of some floating rate yields that you can get on the front end of the curve, obviously people have been flocking away from those because as the bank's been cutting, that's been coming down.
Yeah, for Canada, for sure.
For Canada, for sure. But you have been seeing some interest in those shorter duration products. Because again, that's that front part of the curve that is moving quite a bit. As the bank cuts, you see, 1 to 2 years go down quite a bit. So even, looking at corporate or treasuries within that, you are getting that capital appreciation as rates start to move lower. But we are seeing some rotation. Last month of July, from the fixed income allocation perspective, you did see a lot of buying into the Canadian fixed income market as well. But I think now, the conversation, last year was purely a money market play. This year you're seeing, more in duration products, more in credit and treasuries versus those money market products.
But it's not too late, for instance. I mean, even a week ago we were talking about locking in higher interest rates, getting yourself into a fixed income strategy, perhaps more fulsomely or whatever. But you're not too late now. If that's where you want to go.
No, I certainly don't think you're too late. And again, one of the, I think the conversation and what people need to think about now is, you can get at that short end of the curve, you can get some of that capital appreciation as well, but you do have that reinvestment risk that you have to consider as well.
Okay.
So maybe getting in some duration long on the curve, you got a little bit less of that reinvestment risk because you're locked in for longer, so to speak.
Back to the equity side of things, there's lots of questions about, wanting to go to cash, can we catch this on the way back up? All of those sort of swirling, slightly panicky feelings, right, that come along with a market correction, and what one should do, an investor do, and what advisors should be as they're taking calls from all their clients. So just speak to sort of, the rebound that will inevitably come one day, whether it's tomorrow or a lot longer, we don't know. And also just that idea of sort of diversification timing, what you do with it all.
Yeah, the big problem, I take it to the extreme, saying let's go 100% cash and try to avoid.
Yeah.
The biggest problem there is none of us have a crystal ball. It's near impossible to perfectly time the market. And generally speaking, if you look historically, you don't want to miss those big up days in the market. Yeah. And historically, it's shown that staying invested has been the play. That being said, it's not to say you should go full bore risk and just stay full bore risk all the time. In these times of uncertainty, increased volatility, again, diversification is going to be your friend. You want to mitigate any drawdowns as much as possible. Right. So if you are concerned about kind of moving forward, I think, again, diversification is going to be your friend. Don't put all your eggs in one basket. We've had a little bit of a pullback on Monday here. Maybe it's time to reassess and say, where is my risk? Where can I diversify? How can I mitigate the downside risks? Should I be looking at more bonds to help out with that? Again, like I mentioned, the correlation between stocks and bonds is back to kind of historically what it was, which is being negatively correlated. So those are just things you can look at moving forward and try to insulate your portfolio as much as possible in those large drawdown scenarios.
Yeah, okay, perfect. It's great, yeah, and the large upswing, I guess that's just one of those things that you can either kind of live through this or come in it. There's the catching a falling knife sort of feeling to it all too.
That's right. I think what's also important in times like this as well is I think this is a time where active management can shine, because we've had this pullback. So there's a couple things. There's two thinkings here. We've had a pullback. Is this time to buy the dip, so to speak.
Right.
As the
Some
saying
stocks you've
goes.
been looking at for a while, they're kind of expensive. Yeah.
Now they're a bit cheaper, and then there's the other side of the coin is, well, is there more pain to come? Do I need to be more defensive? So that's where I think, in this scenario, active management can really shine, because they can do that assessment and try to find, those idiosyncrasies between different stocks. Maybe some stocks have gone down and are poised to go down more, and there's good reasons. But perhaps there's other stocks that have been, unfairly been knocked down just because the whole market has gone down. And so that's where you can actually find some good opportunities. So volatility is good for those active managers. They can find opportunity in the chaos.
Yeah, it's like a candy store for asset managers watching markets go down, because they've been waiting for something. Talk a little bit about the vol. Any reason to think that through the rest of this year it won't be a bit choppy?
I would be biased to say things could be choppy for the rest of the year.
Yeah.
We talk about earnings. Earnings have been okay.
Yep.
This quarter around, we're not done. We've got NVIDIA at the end of the month, which I think is going to be another very important data point. I'm sure everyone and their mother will be watching NVIDIA's earnings. But they've been pretty good. In terms of bottom line, I think most of it, is about 80% have beaten, somewhere around that number. The revenue number has been a little bit weaker. Still, I think it was around, last I checked, and people are reporting every moment, but I think it was around 56% had beaten top line. So that was a little bit softer than last quarter, but things are still looking okay. But again, I think there's going to be a lot of uncertainty moving forward. Again, now we're all talking about tech again, and that has been driving the market all year.
Absolutely.
So again, with all that uncertainty, I think we're going to see increased choppiness throughout the year. And again, we not to say, even to talk about the macroeconomic backdrop too.
Sure.
Is this a temporary blip? Are we going to continue to worsen?
Yeah.
Who can say? Only time will tell.
But you have a strategy for that. So you can look at low vol. You can look at a low vol approach.
Yeah.
To investing.
Again, I think. I think it wouldn't hurt to be well diversified going into year end. Again, all this uncertainty, take a look at your fixed income sleeve. And again, if we do go into recession, soft landing, hard landing, what have you, the diversification will help you in that scenario.
There's some great questions coming in here. So Andrei, where do we sit on the US recession story, would you say? You're watching GDP just like everyone else.
Yeah, it's a good question. I think if I was a betting, so it's tough because the data is, if you would have asked me a month ago, I had a different answer for you, but things have changed a little bit now. But I'd say, base case for me, I would say, I don't know if we're going to get a recession this year. We'll have to print a negative Q2 and a negative Q3.
There isn't enough time maybe for it to materialize.
I don't know if there's enough time for it to materialize this year. So I'm like, on a balance of probabilities, I would push it out into 2025. Right now, I'm biased to say soft landing. Yep. But let's see where the data takes us in 2 months.
Absolutely. Okay. And I've got a couple other questions here for you. So how much more of a market rotation do you see? Which sectors might be impacted the most? I guess you're going to say tech, but what else? Yeah, tech is certainly, if you take a look at in July as well, something I feel like we haven't talked about in a while, utilities performed. Wild. I think it was the second best performing gig sector in the United States last year. So that's a signal of some people taking a look at defensive names. Obviously, utilities have historically been a defensive utilities sector. Are different though, because they're attached to some transition stories as well. So they seem to have, anyway, I'm curious, whether you think the sector's changing a bit. Yeah, they're obviously benefiting from the prospect AI. Of lower rates as well. Yeah, obviously, they're typically quite levered, so the prospect of lower rates obviously helps the valuation story a little bit there. Yeah. But certainly, it's certainly a signal to me. I know there's some changes happening under the hood, but historically they've been defensive names, and we have seen as money's been rotating out of tech, we've been seeing money rotate into utilities. So again, perhaps a signal that the market is trying to get a little bit more defensive, maybe taking some gains with techs, because obviously it's had such a great run. Fascinating. Okay, another one. With the Mag 7 decline, thoughts on what investors should consider moving forward? So you've given some great ideas. Maybe just circle back to a couple of those. Yeah, I think when we think about the Mag 7, and we think about, we talk about the S&P 500, for example. So it's a cap-weighted index, so it's very heavily tilted towards those Mag 7. So I think when you're taking a look at cap-weighted index, it might be time to think about stuff that might be a little bit more diversified.
Taking it to the extreme, you can obviously go equal weighted. But there's certainly some happy medium, I think, in the middle where you're getting.
What's the risk with equal weighted?
Equal weighted, your biggest risk is if you continue to get a Mag 7 type scenario, right? If the gains are very concentrated, your cap weighted is going to outperform. But also the reverse is true on the downside, which we've seen on Monday.
Absolutely.
Obviously, if you see that pullback in those Mag 7, that cap weighted index is gonna underperform. Typically would underperform the equal weight, but I think finding something happy medium in between where you are getting a little bit more diversification, whether it's across sector or across single names, is something to honestly take a good look at.
Okay, liquid alts. We talked about them a lot in the past. This is another interesting moment. So
liquid alts it's a big catch-all term for many different strategies. But something I will say about liquid alts and what's interesting is there's a lot of flexibility. Let's think about a long short strategy, for example.
Sure.
So they're on both sides of the ledger, whether being long or short. So they can make active calls about their beta. So if there is increased turmoil, you might see that beta come down. You can even see it go negative theoretically, depending on how they're running the particular mandate. But they do have a lot of flexibility, and the nice part about liquid alts is typically their correlation is different than just straight one to the market. So again, that really helps in those downside scenarios, and they have a lot of tools in their toolbox in order to mitigate some of the downside risk potentially. So certainly an interesting area of the market. Again, their correlations relative to traditional asset classes are a little bit different. So again, that does apply an extra level of diversification, can potentially apply an extra level of diversification in your portfolio.
So it sounds like diversification is sort of the word of this particular discussion, but how would you kind of round this off with some thoughts? Because there is this swirling question of, give me a reason not to go to cash. That always happens in every downturn. But your kind of response and final thoughts on that.
Yeah, I would say, again, I would just reiterate diversification. I also think with this increased level of choppiness, I think active management can be your friend. So I think it'd be important to take a look at some of those mandates.
And globally? Is it a moment to be taking a look at anything globally?
Yeah, right now, if we're thinking about equities, I think, U.S. is still kind of where you want to be. I think there's starting to be some opportunities cropping up internationally, whether you're looking at Europe, who most believe is kind of ahead of us in terms of the economic cycle. So I think there could be some opportunities to crop up just there. I don't think it's right at the moment where we're going to jump head first. But I think we are going to start to see some opportunities internationally as well.
So diversification could mean more globally, but at the moment it's more on the equity side, it's the U.S.
I'm still biased towards the U.S., but I think as we go into the back of the year, I think it'll start to be important to take a look at international as well. Again, as an added level of diversification. Again, if they are ahead of us in kind of the economic cycle, if the U.S. is coming down and Canada is coming down, then again, I think there is some opportunities potentially in internationally.
Okay, really, really interesting. Andrei Bruno, thank you very much for joining us here today and taking us through a pretty exquisite time in the markets. Thank you for joining us.
Thanks so much for having me.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.